Most people think they're protecting their money by keeping it in cash, savings accounts, or safe deposits. In reality, they are steadily losing purchasing power every single year. Not because of bad luck, but because the financial system is built that way. Between 2020 and 2025, the average inflation rate across developed economies was around 4 to 5% annually. That sounds moderate until you add it up. 5 years of 4% inflation means your money lost roughly 18% of its real value. In practical terms, 100,000 euros held in a bank account at the beginning of 2020 now buys what 82,000 euros did. During the same period, most people felt safe because their balance never went down. The number on the screen stayed the same. But the reality is that the value behind that number keeps shrinking, silently, consistently, and permanently. That is the real erosion few households measure. The reason people accept this loss is simple. They confuse nominal stability with real wealth. Seeing a constant figure on a statement feels reassuring. It creates an illusion of control, especially after years of market volatility. Culturally, we have been conditioned to treat cash as security, while ignoring its built-in depreciation. Even many financial advisors encourage this thinking by focusing on short-term liquidity instead of long-term value preservation. Consider a typical saver in Europe or the US. Earning around 3% annual interest on high-yield savings accounts sounds decent. But with real inflation moving at 4 to 5%, the account effectively loses 1 to 2% of purchasing power every year. Over a decade, that compounds into a 10 to 20% drop in what the same money can actually buy. At that pace, the wealth silently melts away, even when the owner never spends a cent. What's more, the financial system rewards spending and punishes saving. Governments use inflation deliberately to reduce the real cost of debt. Central banks target moderate inflation, roughly 2%, not as a flaw, but as policy. It's a quiet transfer of value from savers to borrowers, from individuals to institutions. The saver thinks he's doing the prudent thing. The system knows he's feeding a process of gradual loss. For the past decades, every generation told itself, "I'm playing it safe by holding cash." Yet, when adjusted for inflation, that safety has never truly existed. In 2026, this realization is becoming more visible, especially for people nearing retirement. Their life savings, what should have guaranteed stability, now cover far less than projected a decade ago. The uncomfortable truth is that doing what seems right can be financially destructive if the rules of money change faster than our habits. The challenge is not in earning more, but in keeping what's already earned from dissolving in value. Guido understood that early. He stopped trusting printed promises long before most people noticed them fading. The real question now is, if traditional saving no longer protects wealth, what does? The root of the problem lies in how people structure their income, savings, and expectations. Most households operate on a linear mindset. Income flows in, expenses flow out, and the remainder is held as cash or placed into simple savings products. There is rarely a system behind it, only habit. The logic sounds familiar. I'll save what's left. But this approach assumes that the currency itself stays reliable, and that assumption no longer matches reality. Over the past 20 years, wage growth in developed countries has fallen increasingly behind asset returns. In the United States, for example, median wages between 2005 and 2025 rose roughly 45%. During the same period, real estate values climbed by over 110%, and key stock indexes rose around 180%. The same pattern repeats across Europe. productive effort is earning less compared to asset ownership. That asymmetry drives people to cling to liquidity because they feel priced out of real investment opportunities. Take a middle-income worker in 2026, earning €3,000 per month after tax. They managed to save €500 monthly, placing it in a savings account yielding 3%. After 1 year, they receive about €180 in interest. But in an economy where cost of living rises 5%, the same groceries, rent, and utilities now cost €150 to €200 more each month. In real terms, their savings gain nothing, yet they feel they're doing the responsible thing. The built-in erosion is invisible because it happens gradually and gets masked by nominal growth. Behavioral finance explains part of this. Humans perceive loss more strongly than gain, leading most to avoid volatility. They prefer steady but shrinking value over fluctuating but potentially stable real worth. This inertia compounds across an entire generation of earners. The absence of a structured framework, something that defines long-term objectives, hedges against inflation, and distinguishes between liquidity and value, means people default to convenience. They treat money as a static object, not as a dynamic store of energy that decays when idle. Standard financial advice reinforces this bias. Many retail banks and investment platforms promote diversified solutions, where nearly all components, cash, bonds, and index funds, are denominated in the same fiat system. On paper, diversification looks achieved. In practice, everything depends on the same monetary policies that caused the original problem. Inflation doesn't care whether your funds sit in euro, dollar, or a domestic treasury bill. Their underlying unit erodes just the same. Advisors seldom highlight this because their metrics focus on nominal returns. When an investment yields 5%, but the real inflation rate is 4%, reports still show success. The client sees profit, though purchasing power barely holds. Few institutions measure real return after inflation and taxation, the only variable that actually defines wealth retention. Another subtle cause is the shortening of time horizons. In the digital era, people evaluate performance monthly, sometimes daily. Real wealth building requires thinking in decades. Without that perspective, any strategy that temporarily lags behind inflation appears bad, even if it's essential for stability across a 20-year cycle. Market culture rewards instant feedback, but real financial resilience operates on silent, slow compounding. This is why the problem persists even among educated professionals. They follow the textbook: save, diversify, stay liquid. Yet the textbook wasn't updated for a monetary environment where currency itself is the weakest link. Guido saw this pattern decades ago. Families working hard, saving faithfully, and still ending up behind because the system quietly repriced value every year. He learned that protection wasn't about avoiding risk, it was about choosing the right type of exposure. That's where the next layer of the Goldfinger Rule begins. It's not about speculation or profit. It's about creating a structure that preserves what effort has already earned, no matter what the currency does next. The majority makes 3 consistent mistakes when handling long-term savings. First, they measure wealth in nominal currency units rather than purchasing power. Second, they prioritize liquidity over value stability, keeping most assets in cash or cash equivalents. Third, they diversify only within fiat-based instruments, exposing the entire portfolio to the same inflationary pressure. Let's examine the first mistake. A person sees €50,000 in their account and calls it savings. But if that money loses 4% of value annually to inflation, after 5 years it buys what 41,000 euros did in year 0. After 10 years, the equivalent drops to 33,500 euros. Over 20 years, it falls to 22,000 euros in real terms. The account balance stays constant or grows slightly with interest, but the ability to buy real goods, housing, food, healthcare, shrinks predictably. The second mistake compounds this. Liquidity is essential for emergencies, but holding 60 to 80% of net worth in cash equivalents guarantees underperformance. In a low-rate environment like 2020 to 2025, savings accounts returned 1 to 3%. With inflation at 4 to 5%, the net loss was 1 to 4% per year. Project forward. 100,000 euros saved this way becomes 82,000 euros in real purchasing power after 10 years, 67,000 euros after 20 years. The third mistake is diversification within the wrong category. Spreading money across bonds, stocks, and cash still ties everything to fiat currency. When inflation spikes, as it did to 8 to 10% in 2022 to 2023, all these assets adjust downward in real terms. A balanced portfolio might show 6% nominal return, but after 5% inflation and 20% taxes, the net gain is near zero. Over decades, this leads to stagnation. Now compare two scenarios for a 100,000 euro portfolio starting in 2026, assuming 4% average inflation and 2% nominal savings rate. Scenario A follows the common path. 100% in cash/bonds. After 5 years, real value? 82,000 euros. After 10 years, 67,000 euros. After 20 years, 45,000 euros. Scenario B allocates 20% to a value-stable asset like gold, which historically tracks inflation at 0 to 2% real return. After 5 years, real value, 94,000 euros. After 10 years, 90,000 euros. After 20 years, 85,000 euros. The difference isn't in growth, it's in preservation. These errors create a path dependency. By age 50, many have accumulated 200,000 euros nominally, but its real value is 30 to 40% lower than expected. Retirement projections fail because they use yesterday's inflation assumptions. Healthcare costs, which rise faster than general inflation at 6 to 7% annually, become impossible to cover. The family home, once a retirement asset, now requires selling at a loss in real terms to fund living expenses. Importantly, this isn't tied to income level. A high earner making 100,000 euros yearly can fall into the same trap if they save without a preservation system. A modest earner on 40,000 euros can outperform if they structure correctly. The problem resides in decision-making, not starting capital. Over 10 to 20 years, poor choices turn potential stability into dependency. Guido observed this in countless families during economic shifts of the 1970s and 1980s. Hard workers ended up poorer in real terms despite steady jobs. He concluded that mistakes aren't random. They stem from ignoring the currency's mechanics. The consequences build slowly at first, then accelerate, leaving savers with less choice in later decades. Fixing this requires addressing the errors head-on, starting with a rule that prioritizes value over convenience. That's the foundation of what Guido called the Goldfinger Rule, a deliberate shift from passive holding to active protection. The Goldfinger Rule provides a straightforward system for protecting purchasing power. Allocate 10 to 20% of your total savings to physical gold or gold allocated to your name, held outside the banking system. This isn't about chasing price spikes or timing markets. It's a fixed percentage allocation designed to offset inflation's erosion on the remaining portfolio. Guido implemented this in the 1970s and maintained it through every cycle since. Here's the precise mechanics. Start with your total investable assets, say 100,000 euros across cash, stocks, and bonds. Apply the rule. Dedicate 15%, 15,000 euros, to gold. Purchase physical gold bars or coins from certified dealers, ensuring each piece weighs at least 1 ounce and carries verifiable purity, 99.9% or 4 nines. Store it in a secure private vault, not a bank-safe deposit box, to avoid counterparty risk. The remaining 85,000 euros stays in your usual productive investment. How it works in practice. Inflation hits your entire portfolio equally, but gold's historical behavior counterbalances it. From 2000 to 2025, gold delivered an average annual return of 8.2% in nominal dollars, while U.S. inflation averaged 2.7%. The real return, 5.5%. During high inflation periods like 2021 to 2023, gold rose 25 to 40%, while consumer prices climbed 15 to 20%. The non-gold portion suffers full inflation loss. The gold portion either holds value or gains enough to lift the total. Annual maintenance takes 15 minutes. Check your gold's weight against current spot price, available free on sites like Kitco or Bullion Vault. If your allocation drifts below 10% due to gold appreciation, sell enough to rebalance back to 15%. If it exceeds 20%, trim it down. This dollar-cost averaging into stability prevents both overexposure and opportunity cost. Why stable, not risky? Gold has no credit risk. No bank can freeze or fail it. No interest rate risk. Its value doesn't depend on bond yields or central bank policy. No liquidity crisis risk during systemic stress. Demand surges when fiat confidence drops, as seen in 2008 and 2020. Volatility exists short-term. Gold dropped 30% in 2013. But over 5 to 10-year horizons, it correlates negatively with fiat depreciation. Standard deviation of annual gold returns 1971 to 2025 was 20% versus 15% for stocks. Comparable risk, different drivers. Compare to alternatives. Treasury bonds match inflation only when rates exceed CPI, which occurred less than 30% of the time since 1980. Cash loses by design. Real estate ties you to property taxes, maintenance, and local cycles. Gold requires zero upkeep beyond secure storage, 100 to 200 euros per year. Implementation costs stay low. A 1-ounce gold bar costs 2,200 euros in January 2026, spot plus 2 to 3% premium. Dealers like Degussa or Pamp Suisse charge transparent fees. No leverage, no derivatives, no timing. Buy on personal schedule, incrementing 1,000 to 2,000 euros quarterly until allocation hits target. This creates automatic protection. During 2022's inflation shock, a 100,000 euro portfolio with 15% gold ended the year at 98% real value. Without gold, 88%. Guido tested this through oil crises, dot-com busts, and euro debt scares. The rule held because it doesn't predict, it hedges the predictable. Currency will lose value over time. The Goldfinger Rule converts savings from a decaying asset into a balanced system. Next, we'll structure it into daily steps anyone can follow starting this week. The Goldfinger Rule consolidates into 4 clear steps that form a complete system for long-term value preservation. Step 1. Calculate your total investable assets: cash, savings, stocks, bonds, but exclude your primary residence and emergency fund, 3 to 6 months of expenses. Step 2. Allocate 10 to 20% of that total to physical gold, purchased in 1-ounce bars or coins from certified dealers. Step 3. Store it in a non-bank private vault with allocated ownership. Your name on the bar, verified annually. Step 4. Rebalance once per year to maintain the 10 to 20% target, selling or buying as needed based on spot price. This system runs on autopilot after setup. No daily monitoring, no market predictions, no leverage. It addresses the core problem identified earlier: fiat currency's built-in depreciation. By dedicating a fixed portion to an asset that historically tracks or exceeds inflation, the portfolio gains structural stability, independent of central bank policy or short-term economic noise. Here's what changes over time. Starting with a €100,000 portfolio in January 2026, assuming 4% average annual inflation and gold delivering 0 to 2% real return, its long-term norm. After 1 year, the non-gold portion loses €3,400 in purchasing power. The 15% gold allocation, €15,000, holds or gains €300 to €600 in real terms, lifting total real value to €97,200, a 2.8% improvement over full cash exposure. The difference feels minor, but it compounds. After 5 years, without the rule, €100,000 shrinks to €82,000 real value. With 15% gold, it stands at €92,500. The gap widens to €10,500 because gold stability during inflation spikes, like 2022 to 2023, offsets losses in bonds and cash. Portfolio volatility drops 15 to 20% because gold's negative correlation to fiat stress smooths returns. After 10 years, cash-only portfolio falls to €67,500 real value. Goldfinger portfolio maintains €89,000. By age 60, this preserves enough purchasing power to cover 32% more living expenses, equivalent to an extra €220,000 in today's euros. Healthcare, which inflates at 6 to 7%, becomes manageable. Retirement isn't extended poverty, it's predictable security. Immediate action plan starts today. Week 1. Inventory your assets. List every account balance, subtract non-investable items, and determine your gold target, 10 to 20%. Week 2. Research 3 local dealers. Check LBMA accreditation, premiums under 3%, and vault partnerships. Recommended: Degussa, Kitco, or Bullion Vault for allocated storage. Week 3. Buy your first €1,000 to €2,000 increment via bank transfer. Request assay certificates. Week 4. Schedule annual review on your calendar for January 15th. Deposit the gold in vault same day. Costs remain controlled. €50 to €100 initial setup, €100 to €150 annual storage, 0.5 to 1% transaction fees. Total outlay under 2% of allocation yearly. No tax events until sale. And long-term holding, 5+ years, qualifies for lower capital gains treatment in most EU jurisdictions. Guido applied this through 50 years of crises: 1970s stagflation, 1987 crash, 2008 meltdown, 2020 to 2025 inflation. Families who followed preserved wealth across generations. Those who didn't watched savings dissolve despite steady incomes. The Goldfinger Rule delivers what traditional saving promised but never provided: actual protection of earned value. Implement it consistently, and purchasing power compounds in your favor. Measure progress annually against inflation, not headlines. That's how wealth endures.